Hi there again. This is Robert Schein, Managing Director and Partner with Blanke Schein Wealth Management. Well, today is Friday, the 27th of March. We have markets down a little bit today, off about 3%, off of a pretty historic week from a volatility standpoint. As I mentioned before, we're going to continue to see a lot more volatility. That's part of the process as we go through this bottoming process in the markets in the next weeks and months ahead, as we see our way out of this bear market territory. A couple of key things from our research this morning I just wanted to pass along for my clients, friends and family at home. As one, I hope everyone's healthy and safe. Our thoughts and prayers are with everyone. But we have clients everywhere from New York City, and we checked on them. They're doing well, to Alaska, Florida, as far as Hawaii and everywhere else. So that's why I'm also doing these video updates to make certain that we're all staying to get connected in this time right now. So in our morning research, one of the things I wanted to highlight today, I think it's a keynote of interest and observation, if you will. We were taking a look at some anecdotal data that takes us back to the post-Great Depression, so the 1930s, because what we saw this week in the equity markets are a lot of behaviors in the 1930s where the equity markets are extremely volatile, up 10%, down 10%, back-to-back days in a row. And so what does that mean? What does it look like? And how if there's any correlation? Obviously, history doesn't repeat, but it certainly rhymes, as we say in the financial services industries, as we go through this and look through markets for any sort of anecdotal information that can help us navigate portfolios. One of the key things in terms of the reading that I saw this morning was the 1930s. We had the monetary policy, which is the Federal Reserve. They did four key things, just absolutely wrong. In fact, that's what we've learned from many times in history. One, they raised interest rates when they shouldn't have. Two, they tightened regulations on banks when they shouldn't have. Three, there was a trade war going on in the United States at that time. And then the fourth one, they also raised taxes on corporations. So you got the four different missteps from fiscal and monetary policy of the 1930s that took the Great Depression to a lot longer than it had to be. How is that different than today? Well, yeah, we are in a recession. It could be a technical recession because the markets are down by 20% from the top to closing down over 20%, which actually indicates you're in a bear market. So as I point out, as we had in the 30s, all of the missteps by monetary and fiscal policy, both Congress and Federal Reserve, if you will, that's a lot different. In fact, it's 180-degree different. Key distinction that we're seeing play out today. As again, I keep mentioning that fiscal and monetary policy, Treasury Secretary, and the White House are all working together, and they're working 24/7 to ensure that, yes, while we're in a recession, this could be a short-lived recession. That's one of the base case predictions here for us going forward. While this is a health crisis, and that's the biggest concern, so our thoughts and prayers are to those that are out there, that are going to be infected, and it's going to get worse. And we're going to see the numbers go up in terms of cases, and as well as, unfortunately, fatalities. But that's going to rise over the next couple of weeks, and we expect that and anticipate that, and don't let the headlines spook you, because underneath that, we're also taking care of the health of the economy to ensure that once we can go back outside and go back into this economy, can restart. And maybe it's Easter, maybe it's after that. Obviously, the health professionals will ultimately give us that signal. I think that's their job versus anyone else. But at least it's not a bad idea to have hope out there in the future, because I keep reporting that there will be another side to this. And so what the good news is, and the research that we're reading, is that the Federal Reserve and fiscal monetary policy and White House are doing all that they can to ensure that the other side, we have a rebound. And it could be pretty strong. And I think the demand is going to be pent up in the U.S. economy. So that's it for today. Stay healthy, stay safe, and enjoy your weekend. Take care.